9, 8, 7, 6, 5, 4, 3.
When I started trading, I did pay attention to the nature of the assets I was trading. As long as the technical analysis looked right and my risk management was in place, I thought I was safe. Fundamentals were just news alerts to tell me when to stay or exit. And we have all heard the common rules for the trend. If the market creates higher highs and higher lows, it's bullish, look for buys. If it creates lower lows and lower highs, it's bearish, look for sellers, right? And yet, irrespective of following all those principles, things do not work out. We are told it's a liquidity, or the big boys are hunting our stops. Gurus promise to teach us such secrets or reveal such secrets, yet even after liquidity is taken, the market moves against us. They say the market is expressing itself, but how do you actually listen? So we are going to discuss a powerful tool called sector map that you can find in on a platform called forecaster.biz. This is not my first time to mention this website or platform, but if you take time to understand how it works, you are going to find that is very helpful in your trading and investment. So let's go without wasting much of your time. But I want to first picture this. Assume a human being, as we know, has very many parts. That could be a head, can be a heart, can be lungs, can be your hands, your eyes. But there are several parts that make up a body or a human being. And we have some of the sensitive ones. For example, like a heart. If it stops, a human person dies. If the lungs are affected, it tells us that the lifespan is shorter. The human being is short-lived. So if we can take that analogy or we can relate to that in trading, we have what we call key sectors that make up this asset I'm going to tell you. Yes, the asset is called S&P 500. It's in the stock market. So today we are not going to be talking about synthetic indices. We are not going to be talking about Forex, but an asset in the stock market. Yes, you can find it on the Leaf broker. You can find it on XNS. You can find it on XM, and most of the brokers actually offer this asset you are going to be talking about. We are going to talk about such an asset which is S&P 500, where the name, details, and internal nature matters, because I have realized that some of us, we trade assets, we do not know what they are, their nature, the details about such assets. But today, S&P 500 is an asset you need to know, right? So what is S&P 500? So S&P 500 is a tradable asset, which is an asset composed of 11 sectors. When I said we are going to use a tool called sector map, you can see from the definition I've said it's composed of 11 sectors. It's a globally traded stock index in the US, which has 500 companies within it. And within those 500 companies, we have 11 sectors we are going to be looking at. Okay, so without taking much of your time, let me show you how the sector map works on Forecaster. So get ready with your Forecaster account. If you don't have one, please, it's a matter of signing up, and I will leave the link in the description. And if you use my link, you will get not only the free 7 days trial, but you will also get 10% discount on every trial plan you purchase. Yes, Forecaster is only free for 7 days. Then after, you can begin paying, and the payment looks something like this. Okay, this is the Forecaster terminal I'm talking about, where success comes from having a plan, and you can see this the payments: monthly, quarterly, yearly, okay, and infinity plan, which can also pass on to your siblings. Okay, lifetime updates, transferable to family member or trusted person, or actually continuity once you pay this one for life. Okay, so I want you to sign in, which you can do so from this tab. So once you log in, you land on a page like this. Your page will look like this. Then you have to come, the first step is to come here to the dotted box at the right top right corner. So once you click there, the tool we are talking about, you will find it here under sector map. As I told you in my previous video, this forecaster works like Google, where it has its tools section, and I promise that I'll be making videos explaining each of these tools. So today we are going to explain how the sector map works. So we click here. The forecast will also show you the dates, because I'm making or recording this video on 6th Wednesday of May 2026. So once you click on a sector map, it will directly take you to the S&P 500, which means this tool was designed for this stock market asset, which is S&P 500. And the sectors I was talking about are these. If you count, they are 11. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. There are 11 sectors. But I gave you an example or an analogy, or something to relate to, that in a human body we have two major parts. For example, like a heart, when it collapses, when it stops pumping, then the person dies. If the lungs are affected, then you will notice such a person's lifespan is short-lived, okay? And therefore we are using this tool to predict the market crash. And what I'm trying to mean here is that these two sectors, for example the financial services, are going to be helping us to take the blood test of the market, and that is the market or the price action of the S&P 500, and the other one, which is consumer cyclical, this one, it's here, will be helping us to take the x-ray what is happening inside the S&P 500. Okay, so financial services is the lifeblood of every economy, because the economy runs because there is money. Banks and other financial institutions are what makes the economy booming, and the reverse is true. When we have consumer cyclical, we are meaning how people are spending. If they are spending on luxuries like restaurants, home improvements, tours and travel, vacations, entertainment, all those signals that the economy is doing well. And the reverse is true when you go to the consumer defensive. So let's begin. When you look at this chart here, it looks as if they are plotted in snails. Plotted what? Snails or lines which are twinned, and you may not understand, but each of these is actually a graph showing how these sectors are moving. Okay, so for example, if we switch off, you can toggle off each of these ones. Let me toggle the rest, and I remain with only 3. Are you seeing how the lines are now reducing? Let me continue. You can toggle off from here. Okay. Technology and consumer defensive. So you can see I've remained with only 3, which is the S&P 500, the entire asset and its two sectors, and that is the financial sector, as well as the financial services sector, which is in this pink, and then the other one, which is almost like green. This one is the consumer cyclical. Okay, so you can also toggle on and off from this side, from the graph icon, where you can for example say show all, and you say hide all. Okay, so you can begin selecting one by one if you want, like we had done, like financial services and consumer cyclical, which is here. Okay, the same. So then you can also use this tab, these two arrows. If you want to check the historical data or chart, you can continue zooming like this, just as we do on a chart when we are back testing. So you can see the price action in the past. So you can as well come back to see where you are or something in front using these two arrows. Then we have also the tooltip, which is toggled on. If I move this cursor, you can see how these prices are moving. So for example, if I move like here, currently the S&P 500 is 24.44. It's moving faster, actually 28.47%, which means it is moving faster than most of its sectors. Then if we look at the consumer cyclical, it's just 24.07, and the last one, which is lagging behind, is the financial services with 4.36 in terms of appreciating or going up. Okay, and if you turn off this tooltip, you can't see the data or the momentum of which these assets are moving. Okay, like I told you that S&P 500 is an index, a combination of of 11 sectors with 500 companies. Therefore, this black line represents a combination, an amalgamation of all of those sectors. However, these other ones, which is beginning from financial services to consumer defensive, are the sectors within the S&P 500. Okay, so in this video, as I said, we are going to be interested in these two key sectors, and I explained why. Because financial services carries out or represents the blood test of the market. Okay, it is the banks, the financial institutions that show the economy is doing well, because the economy survives on money. Okay, and the same applies to consumer. Cyclical represents, when I talk about an X-ray, when you go to the hospital and you go into the X-ray, they are able to see what is hidden. Okay, so for us in the market to see what is hidden within the SP 500 movement or price movement, we shall be able to know how people are spending. If people are not spending on luxuries, vacation, entertainment, home improvements, tours and travel, then we shall know, oh, they are cautious. There is something dangerous that is likely to come. Okay, and that is under consumer defensive. If they are not spending on consumer cyclical, then they are spending on basic necessity. Here we have the AI intermarket analysis. We shall come back to it, but it will give us a summary of what's happening, the data backing what is happening on S&P 500 with a conclusion. So if we scroll down, we have time frames. If you're on a chart, or if you have been using a chart, you also have time frames. And these time frames, you can switch to 1 month, you can switch to 6 months, you can switch to 1 year, 3 years, 5 years. So preferably I use 1 year, or you can also use 6 months to see a clear picture. For 5 years and beyond, you are looking at a wider picture. But most of us, we are either intraday traders or swing traders. So I'll remain with around 1 year, okay, for now. So if I scroll down, we have more other tabs, and we have the price change and statistics. Under price change, where we are, you can see all the 11 sectors I've been talking about. And if you click on each of them, you are going to see more details, and you are going to see if, for example, it is undervalued or overvalued, or it is exactly at the fair price. When I talk about undervalued, that means the price is lower than it is supposed to be. When I talk about overvalued, then I say that such an asset is priced higher than its price it's supposedly to be price. So the fair value is the price you are supposed to pay for such an asset, and in this case you are talking about the value of the entire stock. Okay, we also have the ETFs. These are exchange traded funds, which can also be an asset to be traded on its own. So once you click on it, it also gives you more data. Okay, you can see the S&P 500 materials sector is an ETF of the basic materials. You can see its chart, and if you scroll down, you can find more data-driven analysis. Today we are going to be discussing this in detail, but you can also tell us the other 3 powerful tools you can use to analyze this asset. For example, the seasonality, how it correlates with the past. For example, here it is showing it is likely to be rallying from May. Are you seeing this is a good analysis? It is telling with the price action is likely to be bullish, because in the past has been bullish, and you can see the percentage it is correcting 84.46 to in as far as the price action of last year is concerned. Then with 2020 89.71, you can see this is under what price change, where you can find the 11 sectors and their ETFs. Then you can see the time frames here, which means how price has changed over time. For example, yesterday it was positive with 1.67. 1 week ago it was negative 0.30. 1 month ago it was in positive with 1.59% etc. So when we go to statistics, then statistics is going to give us an overview of what we call market mood meter. Okay, this market mood meter is another tool which has been integrated into Forecaster, and the same as like the CNN fear and greed meter, which shows us such assets which are in oversold and overbought a region. So for example, this gives us actually this one is better than the CNN because it gives us a summary of everything. Okay, so it tells us that the 11 sectors, out of the 11 sectors, none of them is in oversold, but 4 of them are in overbought, which means when an asset is in overbought region, what next? It's likely to sell. Okay, so you be on alert to look for sell opportunities. Once again, remember this theme of today, that we want to spot or predict the market crash. That is the stock market crash, where we have the S&P 500 as our case study. Okay, and 7 are neutral. Okay, this is where you see the range therefore. Okay, so if we go into details, you can find that those ones which are in the overbought region, number 1 we have the communication services, the consumer cyclical. Okay, the other ones where people are spending. Okay, are spending on non-essential commodities like luxuries, like cars, fancy cars, home improvements, vacations, entertainment, travel, etc. Then you also have the real estate and technology. Those are also key sectors within the S&P 500, and you can see most of them are in overbought region. The other ones, the other 7 remaining ones are in neutral. So I think they are also likely to come in the overbought, and the more we have in the overbought region, then it confirms our confluence of the market or the stock market crash of S&P 500. Remember, S&P 500 is a common asset traded in the US, not only actually in the US, but globally, just as we know the US dollar. Okay, so that's why I picked this asset. Let's look at January 2025. Okay, actually, let's begin with the January 2026. So you can see this thing which is moving, it is giving me the month and the year. So this is the December. Let's move to January 2026. It's here. Okay, so if it is here, let me first remove one. You see, let me remove consumer cyclical. Okay, I want you to see something. Are you seeing here we have double tops, okay, where the S&P 500 failed to create higher highs? Are you seeing this one here and here? It failed to create a higher high, okay, but created a double top. Whereas when we come to the financial services, can you see what happened? It created a lower high. So if I plot something from here up to here, you are going to see we have a lower high. This one failed to create a higher high. This created a lower high. So that's what we are calling a divergence. A divergence is when one asset creates a higher high and its indicator creates a lower high for a sell. Okay, but in this case, you are not going to be using an indicator, but the indicator itself is one of the key sectors I told you. It's just a matter of picking one of these 2 sectors I've mentioned, which is the financial services, or you pick the consumer cyclical. Okay, If you see both of them giving you a divergence to the S&P 500, then that is great. That's a combination or a combined confluence. But we just need only one of these two sectors to give us a clue of what is happening, what is likely to happen in the S&P 500. So if once again I switch off this one, you can also see the same thing here. The S&P 500 created double tops, okay? No higher highs. It failed to create another high. But here, if we go to the consumer cyclical, it created the lower high. You can see I can even plot it from here up to here. Is that clear? That is January to Feb. January 9th to Feb. Okay? That's when we saw the divergence. So what for? You can see the market crashed up to 30th March of this year, 2026. Is that clear? So let me, even if I also plot the same thing, you can see, okay, the financial services dropped, the consumer cyclical dropped, which means that people stopped spending on such luxuries, non-necessities. Because you see that when the economy is doing bad, you don't spend on fancy or unnecessary items or things like cars or improvements, entertainment, etc. But it's all about consuming what's necessary, what's basic to human life for survival. When people are spending on what's necessary for their human life to survive, then the economy is doing badly. That's what I'm trying to point out. So let's come back to another example. Let's go to January 2025. And as I told you, let's use this to go back. January 2025, it's around here, okay? Good. So if I again, for example, now what do you see, guys? Let me switch off, for example, this one. So can you see something again here? Can you see something around here from here up to here? This is the S&P 500, actually beginning from December 2024, right? No, December 2024, yes. Okay, and up to February 2025. So you can see S&P 500 created something like a higher high. Okay, if I put from this one, okay, up to here, it's a higher high. It created what we call an all-time high, okay, on 18th Feb 2025. But when we come here again on this consumer cyclical, it failed to create an all-time high, but it created what we call a lower high. Okay, so from here to here, this was a divergence. This is slanting, sloping downward. This one is sloping upwards. Okay, so this is also a divergence. So what followed? A crash from 18th Feb, okay, up to, you can see the crash up to 8th, okay, of April. Those are 2 months when the price was crashing. Okay, so that's what I'm trying. That's one. The second example. Let's go to this another example that happened before the COVID-19, and it was spotted a few months in advance. Okay, so let's go to 2020. You know, the COVID crash happened, or COVID-19 happened in 2020, early 2020. So we are going to see what happened again. Are you seeing, guys? It's here. So we are in January 2020. You can see S&P 500 also created a lower, rather a higher high. An all-time high was here. And you can see if we plot this one, there was a higher high. Even the consumer cyclical created a higher high. So where is the divergence? We go to the financial services sector. Even if I switch off this one, are you seeing this one created a higher high? But when you look at the financial services, what do you see? Double tops. It failed to create what? A new high. So it created double tops.
If you want to know if institutional traders are going long or short on this trade, I mean SP 500, you come here to the quote reports and then click on asset managers stroke institutional traders.
And if I click on this information icon, you can see the explanation, and these are institutional investors, including pension funds, endowments, insurance companies, and mutual funds. And this is what in Forex and the other markets, they always trying to convince us, the gurus, that we are trying to follow the footsteps of the institutional traders. If we are hunted out, we are told that these are the institutional traders which are hunting us, or are hunting our stop losses. So here on Forecaster, it actually shows you their movements, their footprints, without just guessing. For example, here, this is the price of or the line chart of S&P 500, and as you can see here, it is still rallying up. It is still bullish. So the institutional traders are here. They have also bought this asset. They haven't withdrawn. The moment they begin selling, you will see them. So I promised to give you the conclusive idea about the AI intermarket analysis, and when you click on it, you're going to see a detailed explanation about what's going around S&P 500. For example, the bullish internal signals, broad participation in recovery. The rally following the March 2026 lows has been characterized by widespread participation across multiple sectors, including information technology, communication services, and industrials, rather than being confined to a single narrow group of investors. Cyclical strength, stabilization of RA leaders. So you can go through it, and you can also see the bearish internal signals, where defensive rotation fatigue, defensive sectors such as healthcare and consumer staples, which often serve as a safer harbor during periods of market stress, have struggled to maintain momentum as the broader market has rallied. This suggests that capital is actively rotating out of defensive positions and into risk-on assets. Limited divergence. There is currently a lack of significant bearish divergence. Yes, we saw that there is currently no divergence, while some sectors occasionally lag or show minor weakness. They are not consistently rolling over or making lower highs, while the index continues to rise, which would otherwise signal internal fragility. So the market implication, or the conclusion, the market is currently in a phase of broad risk confirmation. Yes, we have to confirm with a lot of data, for example, the inflation, the GDP, as I said, and we also continue to look out for these divergences currently, because we realize that the S&P 500 is growing higher, but the other sectors are still lagging behind there. So that could create another divergence, characterized by healthy internal participation and a clear rotation toward growth and cyclical sectors. Sector behavior strongly suggests that the S&P 500 is likely to maintain its upward trajectory in the coming weeks, as the absence of meaningful bearish divergence indicates that the rally is robust rather than fragile. So currently it is bullish, but this may not last long according to my thinking when we are spotting the S&P 500 crash. So for example, let me turn on the key sectors once again, and the consumer cyclical, and I show you what we are trying to mean. So this one is currently making higher highs, leading up. This one is following, but this one, and you see now, you can see this market S&P 500 is behaving like there are three case scenarios: January 2026, January 2025, January 2020. Okay, so stay on the look in the price chart to see
more confirmation, like change of character. So if I take you to the chart and look for S&P 500, which I have already added, you can see we are still bullish. But actually 2 days ago when I was making this video, the price was here, so I was supposed to buy from here. Okay, and you can see it is still maintaining a bullish trend, so watch out for, in the coming, of course, next month, watch out for a bearish scenario confirmation.